From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, waiting for Chairman Powell's next move, hoping for a recovery delayed, not derailed, and watching China's Evergrande approach the endgame. We begin with the big issue, looking ahead to Chairman Powell.
We will all be tuning in.
What happens at the Fed meeting next week?
The next Fed meeting.
The Fed's in a really, really difficult position right now.
The number one thing I'm looking for is any hints towards tapering.
The tapering decision, which we know that the Fed is looking at.
The pressure is there for them to taper.
It's going to be hard to do so if the economic data fails to show up.
It's going to be really, really dependent on the evolution of how the economy starts to move forward.
It's going to be something that the Fed is going to be watching very closely.
Whatever the Fed does or is looking to do could probably be viewed as wrong.
What Powell has to do is he's got to thread a needle.
He has got to thread the needle. Joining us now to discuss Crossmark's Victoria Fernandez, MUFG's George Goncalves, and Krishna Memani of Lafayette College. Victoria, let's begin with you. What are you looking for next Wednesday from Chairman Powell?
Jonathan, I'm not looking for much, really, coming out of this September meeting. Last time we spoke, you asked me if I thought we would get an announcement in September. And I said, no, I think it's going to be November, even possibly December. And I guess I have a little bit of a contrarian view because I think Powell's actually sitting in probably a really good spot right now to where he has an option available to him or evidence either way with the decision that he makes. If he tapers, he can start doing that because there's already been a precedent set with Bank of Canada, with Reserve Bank of Australia, the ECB reduced their amount. But yet we've got data that's come out that has been weaker than expected, not just the jobs report, but other data as well, that allows him to postpone doing that a little bit. So I think he has evidence on either side for the decision they make, but I don't expect anything. It's the dot plot that I think is going to be more important because that's going to give us a better idea of when we're actually going to see rate hikes, whether that's end of 23, beginning of 24.
Krishna, is Chairman Powell in a good spot?
Oh, Chairman Powell is in a fantastic spot. Victoria is absolutely right. He has all the optionality that he needs, and that optionality actually came from muddled data. So he can flip whichever way he prefers to do. And I think right now, there's really no significant reason for him to commit one way or the other and extinguish that optionality when he has no reason to. So yes, I think he's in a good spot. He has no reason to commit one way or the other. It probably comes about in November rather than December, in my view, because I think the growth picture may be weakening, but it is still quite robust, and the inflation picture remains a little bit of a problem for the Fed. So November is what I'm sticking with.
George, do you agree?
Actually, I'll take a different view. I mean, look, they've taken us up to the taper ball. The doors are open. They want us to go into this party or this reduction of, and we've spent this whole year talking taper. They have to deliver. I think the window is closing on them. And if they don't deliver, even if they have optionality, now is the time to do it. Or at least, every meeting is live. Let's put it this way. I mean, even July was live. They were just talking about it. Now they're talking about it further in September. I'm a November person. I think the November is when they're going to launch it, and then we're going to get details in mid-month. But either way, they need to deliver. Otherwise, the window's closing.
George, why do you think the window's closing?
I mean, as my fellow panelists are talking about, the data's not looking that great. But I mean, they've kind of talked up to us to this point of getting everything ready for tapering. If they push it into 2022, then I think it's too late then.
Victoria, we know that if they do move ahead with tapering, they want to aggressively de-link a taper decision from guidance on rates. Do you think that's possible when at this meeting we also get the summary of economic projections, which includes, of course, the dot plot? Does the dot plot, complicate life?
It does, and they've tried really hard to make that statement that these are two different actions, tapering versus rate hikes, but everyone is still going to use the tapering as a timeline for rate hikes, and I think that's why the taper actually matters. It doesn't matter really and truly if they start tapering this month, next month, if it's 5 billion or 10 billion. We know that we're past the need for this emergency liquidity component there, and it needs to come back some. The key here is that it's usually going to take around 9 months to do so, which means that gives us about a 12-month timeline before rate hikes could start happening. That's the key to this, and you're right. We have to see if any of those dots shift from the last meeting. So that summary of economic projections is really going to be key.
Many people think that dot plot will shift. This is Steve Englander of Standard Chartered. He writes the following: we think the Treasury market is underpricing the 125 basis points of hikes by the end of 2024. For the Treasury curve, our base case for the dots and risk impact should underpin the 5s to 30s flattening bias. So let's get to the rate call first, and then we'll deal with the flattening bias after that. Krishna, does that resonate with you at all, that we might be underpricing rate hikes through next year? Or is it just too difficult right now to look at and be precise about what the Fed may or may not do?
Exactly. I don't know how people can come up with estimates that we are underpricing by a precise amount of 125 basis points. I mean, it's market derived, I get it. But, markets are arriving at that through a lot of guesswork. And the data is so muddled right now. And the volatility of the fiscal impulse is so substantial over the next year, year and a half, that thinking that you're underpricing 2 years out or 3 years out doesn't really make any sense to me at all.
George, does it make sense to you? The range of outcomes, potential outcomes through next year and beyond, from my humble position, seems to be incredibly wide. What about you?
Look, the range of outcomes this year were incredibly wide. I mean, everyone was super optimistic. I mean, growth was definitely there, but they were translating that into higher rate forecasts, which really didn't come to fruition. And we're kind of in a deceleration phase, and people are starting to extrapolate the other way. But look, I'm with Krishna. There's definitely muddled data, and it's really hard to forecast in this environment. So I really give kudos to all the economists that are trying. But really, the market is pricing in what makes sense to me. Like, I mean, the curve has to maintain some sort of steepness, and I think the Fed could deliver a way of further entrenching this, breaking this linkage of tapering and tightening or through the rate channel at the next couple meetings. So if this meeting we get further emphasis that tapering is not tightening, at every single meeting going forward, they need to make that case that they're not tightening rates, they're just taking away liquidity.
If it's hard to forecast, and Victoria, some people might argue it's unforecastable data at the moment. Payrolls in the United States, an example of that. Chinese retail sales this week, a great example of that as well. How on earth do you come up with a market call for the Treasury market, Victoria?
Well, I think you have to take a step back and realize that every single data point that we're getting has a thread of the Delta variant running through it. So whether it's the jobs report that we got last month, and I assume we're going to see kind of the same thing for the October report, whether it's PPI, CPI, retail sales, everything has had this thread of Delta running through it. So I think you have to take a step back and say, if we're getting to peak Delta, which it seems like in a lot of the states that are hardest hit we are, then you have to say, okay, what do those fundamentals look like? I am a strong component of watching the consumer. The consumer is sitting really well right now, and it's not a demand problem that we're having in the economy. It's the supply side. So I'm looking at, okay, you're going to probably have some inflation that continues to move a little bit higher. You're having a strong consumer. You have good corporate earnings and margins. So I think that means you're going to see rates move higher. I mean, Lisa Abramowitz this morning, I think she called it a market of faith. And I think that's what a lot of people are having to do. They're having to put a little bit of faith that we're going to get through some of these bumps now, do better in the fourth quarter, and yields will move higher from there.
Let's build on that and use Lisa's word, faith. What do you have faith in? What kind of outcome? And capturing this conversation perfectly, I think, right now, is job openings in America. Pushing 11 million. So let's think about it. As you said, Victoria, demand, no problem there. Job openings, sky high in America. Three options here. And Krishna, I'll start with you and we can work through them together. Either supply issues fade and payrolls surge. Ethan Harris of Bank of America offering up that option. And then we start to meet that demand. Or supply issues persist and wages have to go up aggressively. There is a third option in there as well, that perhaps, Krishna, this demand is time sensitive and the demand itself starts to fade without that supply ever coming through. Which one is the outcome you'd have confidence in going into 22, Krishna?
Well, I think the supply materializes and the demand remains there. The Ethan Harris option that I think that is a very realistic option. And most importantly, whether it is realistic or not, that is the option the Fed believes in. And this market is entirely Fed dependent. It's really not about whether you should have faith in anybody else other than the Fed. It's just whatever they think is what is going to eventually drive the direction of the market.
George, what about you?
Look, I do think that there is challenges in forecasting this environment, and and trying to get this jobs market and figuring out the supply chain disruptions is so hard. And who knows if there's hoarding going on as well. There's a lot of different things. I'm much more on the pessimistic side. I do think there's some sort of, just kind of demand that's been pulled forward, and we're going to probably see that give back into the the remainder of the year, into early part of next year. Doesn't mean we fall into a recession, but does mean that the Fed is kind of tapering into a slowdown.
Give me the Treasury market call then, George. What is it?
Look, the Treasury market has been forecasting this all throughout the summer, right? And so now the question is, do we start to price in the actual rate move higher? And I can't see it really manifesting itself in this environment. There's just not enough good news to kind of push rates higher.
George, Krishna, Victoria, sticking with us. Coming up next on the program, the auction block. Junk bonds kicking off the week with their busiest day of the month. That conversation up next from New York. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with a sizable offering from the EU fueling the busiest week since January. Market-wide sales surging beyond 60 billion euros. In the US, high-grade offerings continuing at a rapid clip. JP Morgan and the big banks leading weekly sales close to $40 billion. And the junk bond market remaining in demand as well. Annual sales nearing 400 billion following another busy week of issuance. Worldwide, the main story for me this week has got to be out of China. We caught up with Bill Lee from Milken. Take a listen to what the chief economist had to say.
Right now, what we're seeing with the potential collapse of Evergrande is the question facing policymakers in Beijing is Evergrande systemic? Is it too big to fail? Is it their equivalent of AIG? And so what we're going to see is the potential for Beijing to step in, if not directly, certainly indirectly, to take on some of that debt and reassure the people in China that their property is safe.
We are approaching some kind of endgame here. I have no idea what the endgame is. Victoria Fernandez, George Goncalves and Krishna Memani still with us. Krishna, I want to come to you first on this question. I think a lot of people outside of China right now don't know what to do with this story. How do you interpret things as they play out?
Well, so in China credit, there is no endgame. Let's be clear about that. There is no end game because the Chinese government and the state apparatus can do lots of things to push the end game to whatever they would like it to be. So I think looking for an end game at this point doesn't make much sense. I think what we are dealing with is a credit tightening in a particular sector that has consequences, and those consequences are becoming painful. So William Lee is absolutely right. I think the hands of the Chinese policymakers are going to get forced to stabilize the situation before it gets out of hand, and that's what they are likely to do. The real question is, what do you do as an investor? And I think that right now, at a certain credit level, it's providing you extraordinary opportunities that you cannot get anywhere else in the world.
Krishna, are you saying you like the look of the credit market in China right now? Is that where you're going with this?
If you look at dispersion and if you look at potential for alpha, if you can call it right, that is probably the highest there than it is anywhere else. What are you going to do in the U.S. high yield market at 3.5% yield?
George Goncalves, your call.
Look, I think people have to be cautious with that. I mean, I think that if there is any sort of systemic risks, it would have been more present at this point. But the Chinese government has a social pact with its people, and whatever is going to happen, they're going to take care of it either through restructuring or capital injections. Whatever has to happen will take place. But I do think it's kind of endemic of what's going on more broadly in credit in China, and this need to kind of ratchet things back down. Look, long term, saving through properties or buying through properties, whatever's been going on for the last 10, 15 years in China. Yeah. Probably not the most optimal solution, and there's going to need to be more of a social safety net for the general population. But that's a bigger government issue to deal with down the road.
There's one thread, though, that's consistent in every single response I get to these questions, is that the policymaker in China can get the result that it wants. Bridgewater brought this up as a bit of a problem. We have been conditioned by recent history, to believe that the policymaker can get what it wants in the United States and China as well. Victoria, I just wonder how comfortable you are with that assessment, that the policymaker in China can continue to get the outcomes that they want.
So as an investor, I'm not comfortable with that. I mean, you look at this Evergrande situation, we're talking 300 billion in debt that could come crashing down. And you've already got banks in Hong Kong and in mainland China that are not lending to other firms associated with Evergrande. And so you wonder what that contagion is going to look like. We don't have exposure, whether it's on the fixed income side or the equity side, to mainland China. I mean, because of the way that the government works, because of the restrictions that you have there, because of the new regulations that are coming out and the uncertainty surrounding that. So for us, we would much rather look domestically for our fixed income. And when we're looking at equities, there's other places we'd rather be internationally, whether it's the UK, the Eurozone, and Japan is probably, those are our top three right now.
That's the challenge right now. You look to China, you've got a regulatory regime that is totally unpredictable. You've got data that so far this week has been completely unforecastable. And you've got dominoes to fall and you don't know where they're going to fall because you don't know who holds the debt. Now, Krishna, I want to come back to you because you made a bit of a call that you might be looking around the Chinese market. I want to understand how you'd approach that situation at the moment, Krishna, without really knowing where these dominoes could go, without knowing who holds the debt. How do you make that call at the moment?
Well, so I think if the Chinese credit market for sure and Chinese credit market today ends up being a macro call far more than an individual sector call. So the point I'm trying to make is the pain with respect to the real estate sector is so substantial at the moment, and especially with what's going on in Evergrande, that the Chinese policymakers don't really have a choice. So it's a call based on that. And then you find the strongest credit within that call that you think you'll be able to buy and generate
Krishna, just
quite
to jump
substantial
in,
level of
forgive me
returns.
for jumping in. Do you think we have seen sufficient pain before you make that move, though? I know in hindsight, when you look back, you have the clarity to say that was the time to buy. And I know this is really, really difficult. That's why I want to explore it with you. How do you know when to make that entry point? When to time it? Because when I look at things right now, back in 2015, Krishna, when they had problems, it took a long, long time to work things out, and they threw a lot at it.
So again, you won't be able to call the bottom precisely. But I think given what is going on with probably one of the largest entities with lots of pain points across the financial system and across the general populace, I think it's a fair assessment to make that it may not be the bottom, but we are probably getting closer to the bottom with respect to the pain point of the policymakers.
Really interesting conversation. Krishna, George, Victoria, sticking with us. Still ahead, the final spread, the week ahead, featuring Chairman Powell and a Fed rate decision. I believe you hear from the chairman twice next week. We'll get into that in just a moment. From New York, this is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, central bankers returning in force. We get rate decisions from the BOJ, the BOE, and then the Federal Reserve on Wednesday. Jobless claims and a host of global PMIs on Thursday. And rounding out the week with a ton of Fed speak, led by Chairman Powell and Vice Chair Richard Clarida. Back with us for some final thoughts. Victoria Fernandez, George Goncalves, and Krishna Memani. Victoria, first to you. When you look across the world right now, the Bank of England, the BOJ, the ECB, the Federal Reserve, where do you see the first real tightening coming from?
Yeah, you would anticipate that from the U.S. would make a lot of sense just because we had so much liquidity in there. We should have probably already started tapering. I mean, our discussion earlier really is more what the Fed is going to do, maybe not what we think they should do. But I think maybe you're going to see it come a little bit earlier from somewhere overseas. Maybe you see from the Bank of England start to come first, although they've had some really poor data that's come out this week as well. So, you know, I don't know. You may have to roll the dice on that. I think they'll probably play off each other a little bit, the same way that they're going to do with tapering. But I would still say we're looking at 12 months at least before we see it from anybody.
George, what about you?
Yeah, I'd probably say the Bank of England makes the most sense here. I mean, we're obviously seeing a lot of emerging markets concerned about their currencies and just overall inflation. But, I mean, it's going to really take time before the developed markets start to kick in and have that same sort of fear because everyone still thinks it's transitory. So I'd say probably overseas first, and the Fed's very close to right after it.
I sense from you, George, that you've got some real reservations as to whether this is transitory or not.
On the inflation aspect?
Yeah.
Look. I mean, I think the problem is, like we've said at the start of the show, there's all this unevenness of data, and we're going to see kind of a pipeline pressures come in later with shelter inflation, and so it's going to really make it challenging for the Fed when we're still going to have super high inflation into the end of the year and into the early part of next year, and the economy is not producing the sort of growth that they want, but they're still tapering and trying to lay a path towards hiking. So that's why it makes it harder for them. But the one thing I do know is that the Fed has institutional memory around inflation, and the longer that it persists, it's going to force their hand.
Krishna, final word on that.
Well, so I think George is making a very good point. That is, what we are talking about is the Fed tightening in a cycle that is actually slowing. So that's an enormous amount of risk that the Fed is taking if they go down that path. So therefore, I think my conclusion, based on what George's argument is that they probably don't do anything, and they, other than tapering, they don't give you any indication whatsoever that they are inclined to tighten anytime soon, because otherwise they can create a big problem for themselves. And Fed has no reason, despite the inflation print, because they totally believe it is transitory, for them to do anything anytime soon.
Let's play that game right now. The final round, the rapid fire round. And I want to start with the taper question. 3 quick questions, 3 quick answers. The taper decision, September, November, December, or overtaken by events? Which one? George?
November.
Victoria?
November.
Krishna?
November, I guess.
Second question. Does Chairman Powell get a second term? Yes or no? Krishna?
Yes.
Victoria?
Yes.
George?
Yes.
Final question for you. Debt ceiling debate. If the debt ceiling issues get dicey, are you a buyer of treasuries or a seller of treasuries? A buyer or a seller? Victoria?
Seller.
George?
You have to be a buyer.
Krishna?
100% buyer, but it's a total waste of time because nothing will come about.
Isn't that the moment we're in? It's just crazy town all the time. Victoria Fernandez, George Goncalves, and Krishna Memani from New York City. That does it for us. We'll see you next Friday. Same time, same place. This was Bloomberg Real Yield. This is Bloomberg TV.